Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Paris rapeseed, Winnipeg canola, and Malaysian palm oil markets. I'll start with Paris rapeseed. Until recently, there were two key patterns here. Now there are three. There may even be more. The first and large one is the February 2021 to July 2022 ascending broadening wedge pattern. Currently 751 and a quarter to well off the top of my daily chart, far enough that it becomes immaterial. It is highlighted on my daily chart in blue. This was not a perfect pattern, but it had been the main market driver higher in the early part of this year. The break lower in July left the following incredible targets on the downside. The primary target X is in the 352 area, with a harder to reach secondary target X1 in the 217 area. These are obviously, well, pretty much way out there targets that you can put into your diary or on the back page and just look at maybe once a year or so. The second smaller pattern was in development until the end of September, and on the surface seems a more reasonable opportunity. It was created from the break lower of the larger pattern in June and July and is an optimized falling wedge pattern. I've highlighted the falling wedge pattern in red. The key features in this pattern have been the temporary halt to the decline at the February low at 599.75 back in August, the earlier breakdown through the 50% Fibonacci line of the December 2020 to April 2022 move at 644, the false break lower in mid-September below the lower trend line, and above all of these, the break upwards and out of this falling wedge pattern at the start of October. This break higher ran into a lot of headwinds in its attempts higher during the early part of October and was until this week attracted to the duo combination of the 50% Fibonacci line of the December 2020 to April 2022 move at 643.75 and the medium moving average, currently 637.75. Now, before I start recapping the possible upside targets for this pattern, which I had previously set out, I'd like to reiterate something I've said here these past 6 weeks now. There is a key problem with this pattern. It has been created in the wrong place. By that I mean it should have been formed after we'd had a prior ascending pattern, not as in this case after a great big gapping drop lower. This had previously led me to suspect that perhaps the pattern may morph further along into something else until recently I had not noted anything special, but 2 weeks ago I was minded to look at the action as a third pattern, a late June to date very big V-bottom pattern type, an extended V-bottom with a flat hesitation area formed during October which extended into November. This pattern gave potential up to the 690 area, and it would in part tie in with the potential upside targets for a break higher from the falling wedge pattern of a primary target X2 in the 702.75 area and a harder to reach secondary target X3 in the 757 area. 2 weeks ago, the market broke up over and started to stabilize the 50% Fibonacci line of December 2020 to April 2022 move at 643.75, which had earlier been a stubborn stain that didn't seem to want to move. We also had coming in from above the declining medium moving average, currently 637.75. And this now became very important. Well, it shortly became very important. All this effectively created a new resistance, one that hadn't been tested since June. So I was cautious at the time when mentioning it. At the end of last week, the market started dipping below the comfort and security of the 50% Fibonacci line at 643.75 and the medium moving average. I said last week, and I quote, "My only concern is that hanging around here too long and the market may well give up the nascent bullish incentive and we start seeing disappointed longs liquidating," end of quote. Well, that's what seems to have happened this week, with prices punching and then gapping below the flatlining short-medium moving average, currently 627, below the 50% Fibonacci line of the March 2016 to April 22 move at 613.75, and approaching the next support and testing it now as I speak at 599.5. We may even now have the next support below that in the frame, and that's the March 2021 uptrend, currently at 587. Indeed, because I value the gapping move earlier this week so highly, this may well be on the way to a really big double bottom pattern from June to date. I am not certain on this, but it is worth now considering. There's one final thing to remember and to consider. With just under a month to go to the end of November, the market is already set up to be a monthly key reversal. If we close on the 30th of November, either over 665 or under 635, then we'd be on. Right now we're looking at a monthly key reversal down. Just please remember we still have about 2 weeks to go and things may change. Winnipeg canola. Whilst the September 2021 low at 839.20 and the August 21 low at 817 both acted to halt the declines back in late June and early July, it was originally the 50% Fibonacci line of the October 2020 to April 2022 move at 863.80 that triggered the retro reverse engines to pull prices up all the way back in late June, which is kind of ironic as this same 50% Fibonacci line has during most of October been acting as a support for what looked like an attempt higher. Going back to the summertime for a moment, it became evident since the start of the sideways to slightly lower movement we've seen here since June that there was a shallow bear channel, currently 773.90 to 873.40, and it is this that had been driving the market lower during the summer. To emphasize this point, I'd like to recap some of my commentary from 3 weeks ago, and I quote, "So, it seems that until that slightly bearish channel breaks or morphs into another pattern, it will continue to show the slightly bearish angle of attack of this market." This leads us to what has happened since mid-September today, where we had a nice rally from the bottom of the bear channel, reaching the upper bear channel line at the start of October. Since then, we have been confined between the upper bear channel line and the 50% Fibonacci line at 863.80. This situation cannot last, even though ranges could narrow into the start of December. I suspect an event will take place that will trigger a move before then. End of quote. Well, that event happened 2 weeks ago, with multiple closes over the upper bear channel line, and also the whole of October's action, between roughly 863.80 to 880 even. This zone became support. This leads to something I highlighted 3 weeks ago, and I quote, "So what is there left that could influence the market?" Well, I had previously discussed the idea that perhaps, just perhaps, the mid-September today action is in the form of a rather flat, bullish halfway hesitation. I'm not altogether happy with this, but it may just fit. If it does, and is way early so far, then we could be looking at a move up to the 960 area. Mind you, at this time it could quite easily be a topping action, and we could see lower bear channel revisited once again. End of quote. Last week in this, the market started to seriously take on the idea of a flat bullish halfway hesitation. However, once prices rose, they what did we have overhead that might impede the move higher? Well, the obvious ones were the highs of October at 898.5, July at 904.30, and late June at 912.70. Plus, I'd add the 50% Fibonacci line at 921.70 of the January 2021 to April 22 move. With all these, it ended up being the late June high at 912.70 that stopped the market and started the latest move lower. Admittedly with the help of a bearish tri-star pattern I'd highlighted made at the highs. Prices went down through the upper bear channel line, the 50% Fibonacci line at 863.80. We're now testing the combination of the flatlining short medium moving average, currently 852.5, and the medium moving average, currently 851.10. Below this is the summer 2021 low at 839.20 and the August 2021 low at 817 even. Above all this, we could be back within the bear channel and the market could start repairing the damage to the upper bear channel line made over early November. Add to this one final point. Prices have dropped down that far today that we are set for November being a monthly key reversal. If we then close on the 30th, either over 879 or under 860.20, then we'd be on. Right now we are looking at a monthly key reversal down. Just remember, we have still about 2 weeks to go of this month and things may change. I will likely retire the idea of a possible bullish halfway hesitation at that time or probably before then. Bursa Malaysia crude palm oil. Superficially, you might think the break higher over the short medium moving average, currently at 38.46 and highlighted in green on my daily chart, was a key moment in the move higher in recent days. And you would be partially right, but not wholly. You see, over September and mid-October, the market formed a small but effective reverse head and shoulders pattern, which I'd highlighted on my daily chart. And it was a combination of the break higher over the neckline of this chart, this reverse head and shoulders pattern, as well as the old neckline of the September 2015 to November 2017 head and shoulders top. That's currently at 38.67, which is highlighted in red. And finally, also the break above the short medium average that altogether caused the move up since mid-October. This move higher gave potential targets on the upside of a primary target X in the 42.45 area and a secondary harder to reach target X1 in the 44.40 area. 2 weeks ago, prices reached target X and came close to target X1 as well, but finished with a bearish shooting star pattern. Interestingly, at the time, this raised the idea of whether this shooting star pattern was a type 1 bearish or type 2 bullish. It ended up being a type 1 bearish, and after some hesitation the market followed through lower with this bearish action. However, this week prices dropped below the slowly declining medium moving average, currently 39.73, as well as the congestion at 39.53 to 39.86. And in today's aftermarket session we've moved down to test both the head and shoulders neckline and the short medium moving average. We have next below the extension of the small neckline, currently at 36.08, as well as the lows from the two shoulders. However, before then, we still have congestion. Still have to have consecutive closes below both the nearby neckline and the short medium moving average to confirm anything, and that will be the first thing to look at. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.